Let's go macro, bring in Eric Robertsen, Global Head of Research, Stanchart, joining us live down Sydney side. Eric, great to see you. Appreciate your time. Belated Happy New Year. Hope you're continuing to keep safe. Now, two things that happened last week are making a lot of people, including yourself, think a lot more about inflation down the road. Saudi Arabia, that surprised 1 million barrel a day production cut. Then you had the Georgia runoff elections, Democrats sweeping in both seats, almost ensuring or guaranteeing bigger stimulus from the incoming Biden administration. I think the question is, how are they going to pay for it? What are your thoughts? I mean, because when it comes to market pricing, we're north of 1% on the 10. We've got calls now. We could see double that, 2% by the end of this year. You think we will?
No, I don't think so, Martin. Look, our baseline view remains that inflation will remain relatively well contained. If you look around the world, you have inflation rates in large parts of Asia, including China, at 1% or below, and that's 2/3 of global growth, right? So there's a large part of the global economy that is still experiencing disinflation. It is clear that there has been a change in the risks with the increase in fiscal stimulus that is expected out of the United States, obviously higher oil prices in response to the Saudi announcement. I think you will see market expectations of higher inflation trade higher over the next couple of months based in response to these developments. But underlying inflation is a function of a lot of factors, and I don't think all of those factors are pointing to higher inflation just yet.
Eric, when you look at some of the indicators that determine whether risk assets are massively overbought or even a bubble that's fit to burst, what are they telling you? Are they warning you about that?
Well, I think it depends on which markets you're looking at, Sri. Everybody focuses on the U.S. equity market and technology stocks there. They've had an enormous run, and as you were saying earlier on the show, they seem to be indifferent or impervious to any of the risk factors which come about. Our contention, though, is that if you look around Asia and emerging markets more generally, there's still great pockets of value. Emerging market equities still trade cheap to us, in our opinion, relative to developed markets. Emerging market currencies still look to have quite a bit of value, and emerging market fixed income, I would argue, also looks relatively attractive. So totally agree with you. There are some markets, especially in the developed world, that look frothy at the moment, but I don't think you can apply that label to all markets globally.
Eric, we could break it down. I'll leave Saudi Arabia, production cuts, oil, commodity price inflation to Sri. He's the man on that front. But on fiscal stimulus and the Biden administration coming up with more spending, obviously it's got to be paid for, right? They could raise taxes or they could issue more debt. On the debt road, if they do that, means more supply, pressures prices, pushes yields up. I think one of the key questions is, and bond guys are starting to ask this, is, look, is the Fed going to continue buying at $80 billion a year, or are they going to start, I hate to use the word, taper? Because a lot of these bond guys are starting to worry about that.
Look, obviously, Martin, this has been the key kind of question and the narrative in markets over the last 4 or 5 trading sessions. Our view is that the sentiment in the market with regards to the Fed has swung too far too quickly. A month ago, in the fourth quarter of last year, we were talking about the Fed potentially expanding its asset purchases, extending the weighted average maturity of their bond purchases, and now all of a sudden we're talking about tapering. I think it's premature. I think it makes sense for the Fed to discuss an exit strategy. I think it makes sense for the Fed to talk about the conditions under which they might start reducing asset purchases. But for the moment, they're buying $120 billion of treasuries and agencies per month. I would argue that continues for the foreseeable future. As you say correctly, there's quite a bit of fiscal stimulus coming. I don't think the Democrats will raise taxes as quickly as they increase stimulus, so they do need to pay for that, and that will mean some debt issuance. The Fed will be highly sensitive to an increase in both nominal and real yields. I think they will want to control that at some point. And so I don't think the Fed will be at all comfortable allowing long-term interest rates to go meaningfully higher in the short term.
Eric, you bring it back to this region, and you were saying earlier how you feel that there still could be some headroom and upside for emerging market equities and risk assets. But when you look at the more developed end of the spectrum, I'm talking about the Nikkei 225 knocking on the door of 30,000. I know we're not trading today because it's a holiday there, but when you look at the Kospi today, up by 2% and at a new record, is that telling you that the more developed end of the market is looking pretty fully priced at the moment?
Look, let me play devil's advocate to you, Shri, for a second. One of the things that we've been very focused on is the amount of capital or cash sitting on the sidelines. If you look at Asian equity markets in general, last year at the peak or at the worst, they saw or had seen about $75–80 billion worth of outflows. It's our estimate that we've seen only about 20 or 25 billion of capital return to those markets. So there's still quite a bit of cash sitting on the sidelines looking for a home. If you look at U.S. money market funds, last year at the peak of the crisis, they had seen $1.4 trillion of inflows. Only half of that money has been reallocated, so 700 billion sitting there. And we also know anecdotally that emerging market dedicated funds are seeing new cash coming from their end user investors. So for me, the flow story is very compelling. The growth story in Asia remains equally compelling. And as we talked about or alluded to earlier, monetary policy will remain supportive and friendly. So I think some of these markets still have more room to go.
More room to go. So let's talk about that because, when you take a step back, a lot of people are starting to remember, we are in, could be late stages, last legs of one of the longest bull markets we've ever seen, all right? We had an expert earlier this morning saying that likely the come down, whether it's a big pop or just letting the air out slowly, is probably going to be sometime second half of the year, coinciding with peak vaccine, on the thinking that, look, things aren't going to be so smooth and it's not going to be mid-year, more likely second half of the year when we achieve herd immunity or whatever. Do you subscribe to that view?
Look, I understand where it comes from. I'm not sure I would describe myself as a subscriber to the view. Look, I didn't see that segment of the show, but what I can imagine your guest was saying is that there's a lot of good news being built into market prices at the moment, whether it's fiscal stimulus, vaccine, a normalization and pent-up demand, quite frankly. And that once that news hits, what will be the new factors to drive markets higher? I guess my counter to that would be that we've just experienced a 1 in 100 year event. And so the recovery from that event is going to receive maximum support from not only central banks, but governments as well in the form of fiscal stimulus. It's almost going to feel like a post-war recovery. And so I don't think that governments or central banks are going to back away from supporting that economic recovery until they are 100% convinced that the recovery is benefiting as large a percentage of the population as possible. So I think we're going to see quite a bit of policy support well through 2021.
Eric, near term, we got earnings season stateside kicking off this week, in fact, at the end of this week on Friday with the banks. Is this largely going to be positive, negative, or a neutral event for the markets? And as far as longer dated yields are concerned, now that they are over 1%, how much of headwind is that going to be?
Well, look, Shri, I understand your question. We've moved a long way from the lows in Treasury yields back in sort of March, April, May of this year, and relative to those lows, a 10-year at 1% may look prohibitive to risky asset prices. But 10-year yields are still well below where we were pre-COVID, right? And so when I think about that narrative and I think about the amount of stimulus in the system and the amount of fiscal stimulus that is still coming, I don't think a 10-year yield at 1% is necessarily disastrous. In terms of bank earnings and corporate earnings that we're going to see over the next few weeks, they will be for the fourth quarter, right? And the fourth quarter, I think, as we all know, was a period of kind of peak optimism about the economic recovery, vaccines, reopening, et cetera. From a tactical point of view, I guess I'd be more worried about the second quarter. A lot of the base effects from an economic point of view and even an earnings point of view will be at their max at that point. And then where we go from there, purely from a year-on-year comparison, will become more challenging. So that's where we'd be a little bit more cautious.
Indeed, the comps are going to get more challenging. Understood.
Eric, I'm afraid we're just out of time. We're going to wrap it up there, sir. Thank you very much indeed, as always. Eric Robertsen there from Standard Chartered Bank.